G'day, Matty Miners. Big humdinger of a bloody guest for this one. The main man from Perseus, live from Indaba. At the time when you recorded it was live.
Mate, it was more than live. It was the day after it became apparent that Zijin and Lundin were collectively putting in a strategic placement into Predictive. So, and we didn't shy away from asking him about it either.
Yeah, good yarn.
It was great. He said right as we met him, shook his hand. Yeah, we're not going to talk too much about it, but we couldn't keep quiet. First question, straight out the blocks. We had to ask him about it. And yeah, Jeff is a real gentleman. We spoke about everything from operating in West Africa, hedging, M&A, how we use it, everything that sort of came to mind. It was awesome to pin him down in a super busy few days while we're over there in Cape Town. And we're excited to share it with the money miners.
Very, very good. Righto, let's get into this big humdinger of an episode. Brought to you by the big humdinger Crotro, boys. The 4 pillars of bloody excellence: tech services, products, projects, and operations. Right. Originally an underground specialist, but now they are looking at the sunshine. I'm talking EPC builds of 50 mil or more, not just paste plants. Any bloody plant. These guys are going bid, and holy snap and duck shit, they're good at building paste plants.
50 mil or more. I thought it'd be a multiple of 4.
Chuck a 0 on, mate. Chuck a 0 on. All supported by the 4 pillars of this sensational engineering company. Now we'll get into Jeff Quartermaine.
Go, Quattro.
Let's go. All right, money miners, we've got another awesome guest here at Indaba, Jeff Quartermaine, who leads Perseus Mining. Jeff, thanks for making the time and coming on the show.
Oh, thank you. My pleasure to be here.
Now, we've got you at a very interesting time. There's been a few developments in West Africa, a whole bunch of things we want to talk to you about. But first and foremost, we're going to have to put you on the spot and hear a little bit about a company in which you own just under 20% in. What's going on at Predictive and what's going to happen from here?
Well, that's a very good question. Well, as you're aware, they have made a placement of shares to the Lundin Group and also Zijin, who are now on the register, and we'll see where things go from here. But at this stage of the game, it's fairly early on in the piece, and we need to consider what it means, and we'll make appropriate moves from here.
When you acquired the 20% stake in Predictive, the vendors, from memory, the share sale agreement included a call option whereby effectively if you lobbed a change of control before the 31st of December 2025, those vendors would get 100% of the uplift in any in any event. So
no, I think actually they get 50%.
50%.
So
okay.
We share the upside.
Share the upside. Gotcha. So you would have incentive to play the long game.
Well, yes, you're quite right. Theoretically, that's true. But to be frank, if we felt it was worthwhile going forward now, we would go forward, and that would certainly not be our prime motivation, let me say that.
It was a really interesting comment you made in the quarterly call just gone, where it was great. You pointed to the valuations that some research analysts were putting on undeveloped projects, and there was words to the effect of some people's job are clearly to promote a story, not to properly value a company. So are you of the opinion broadly that valuations are pretty rich amongst the undeveloped?
Oh, I think it's fair to say that. I mean, and it's not a criticism per se of people, because we have a different, our business is different. Our business is about creating value, monetizing natural resources. Now, what that means, of course, is that we need to invest the capital to develop and then extract the money. What gets overlooked quite regularly in the analyses that are presented, people put DFS out, which is 100% of the project. Well, in Africa in particular, many governments have interest in the project, like have a carried interest of 15 or 20%. So that means that you're not entitled to 100% of the cash flow, you're entitled to maybe 85 in the case of, say Guinea. On top of that, depending on how you finance the project, once you've recovered your debt finance, the intercompany debt, you distribute money by dividends. Now, dividends attract a 15% withholding tax. So for someone like us, we would be getting 85% less, the less 15% of 15% basically, which is the withholding tax on the government side of things. So the thing is that there's a lot of leakage between the project and your bank balance. And our success in investment is measured by the return on the funds employed in the project, including the acquisition costs. So our equation is very different to the equation that other people have when they're looking at these projects. As I say, look, I'm not critical of them. They have a valid role, but it's not correct to compare the two things.
How has the run-up in gold over the past couple of years, specifically when it's gone really hot, say over 2024, changed the approach of yourself and Perseus toward M&A? How's the thinking kind of changed?
Oh, well, look, it's quite interesting when you look at our company. Very early on we started off as a one mine company in one country exposure, and I realised very early that was a very dangerous, very risky way to live your life. So we decided that we should seek to diversify countries and also projects. Now, having done that, the question was, well, how do you do the timing of the investment? At that stage of the game, we were almost at the bottom of the cycle, and many people said, you're mad, you shouldn't invest at all, you should be protecting your capital base. I took a contrary view to say, no, we should be investing now because we want to be producing gold and selling when the cycle turns, and not building when the cycle turns, because the cost of building is so much higher. And we did that. We built at the bottom of the cycle, so we're starting to produce gold. If you look at one of my favourite charts, which was in all of our presentations, it shows the production profile steadily rising over the last 8 years or so. It shows the operating costs, the all-in site costs, reasonably flat, but the gold price is rising and the margin's increasing. What better time to be increasing your production when the gold price is rising? You're maximising your cash generation, and that's largely what Perseus has done, and that's why we have $704 million in the bank at the end of the year.
Your point on the leakage that happens with M&A, I probably hadn't thought about that in the context of the options you had. We've often commented about your M&A ambitions, which have been well executed, and you've created so much value through the development of assets that you've acquired over time. But in recent history, we've always said, why aren't you just buying back your own stock?
Well, we are buying back.
And you did subsequently announce a maiden buyback of up to 100 million.
Well, this year it's 100 million, and the reason it's not larger at the moment is that I've never done a buyback before, and I have to say I was a bit sceptical about the real value of it. But the last 6 months, and I have to say we can't trade all the time because we're frequently in blackouts, but it has really changed my opinion. We've been able to use that buyback mechanism as a sort of a strategic tool to keep out a bit of balance in the stock, particularly over the holiday period where volumes were very light and there was quite a bit of volatility coming out of the United States. So, unchecked, a little bit of bad news out of the US would push the ASX 200 down and push our stock right down to start off, and then you'd be recovering from the hole. So we were able to step into the market under certain circumstances and hold our stock at a reasonable level. We don't stand in front of trains, I might say. I mean, if there's a huge sell-off, it happens. Similarly, we're not chasing the market either. If investors are buying, we let it go. But it's a very valuable tool to be able to take the volatility out so that shareholders have a little bit of certainty about what their stock is worth. And the other thing that, of course, it does is it gives you a better base for when you bring out very good news like we did with the quarterly report and our financials to come, because you're leveraging off a higher base in terms of the future share price.
When we look sort of like broadly at the gold miners historically, there's this real tendency to not be able to expand margin even when gold price goes up, or maybe there's a window when it happens, but then it kind of it's kind of given back. What is actually key to managing costs as a gold miner? How do you actually have margin expansion?
Well, managing costs, I mean, you've just got to work day in, day out, basically, and keep looking for ways to improve your efficiency and your business. So, whether it's a technological change like we have recently, used different software for designing blasts, which has been very good for us, gives us less dilution, things like that, or whether you do other things. One of the most important things that we did was we worked extremely hard we've always worked very hard at cultivating our workforce and genuinely creating a team, creating an environment where people want to work. And I can tell you what, it makes an enormous amount of difference. Certainly in Ghana, it's very evident. We're producing at around $1,000 an ounce, and our team are immensely proud of what they're doing, and we encourage that. So there's all sorts of ways to become a better business if you look hard enough.
And investing in the assets, does that come more to the fore as prices rise? It becomes more of a seller's market. Say you don't want to sell any of your assets, but buying is kind of off the table in a sense. Do you just think a lot about changing your MO in going out and buying, or does the attraction to actually investing in the assets that you've got, lifting the ounces there, improving the margin, become the core focus?
Well, look, we have very specific, financial targets, returns on investment and things of that nature, and we're quite disciplined. We won't chase a situation just because. At the moment, for instance, you're right. The prices out in the market are pretty high because people are opportunistically using very high gold prices on a long-term basis. Now, they may be right, I don't know, but historically speaking, it looks ambitious. For us, what we do is we look closer to home. The best development opportunities we have are adjacent to our infrastructure that's already been paid for and is operating and de-risked. So we're looking around all of our properties to see, well, what opportunities do we have here? Now, you might have seen that we recently announced the decision to go underground at the Yaouré pit, at the Yaouré mine off one of the pits. Now, the beautiful thing about that particular exercise is we have a mill already built, paid for and operating extremely well. So, the cost to us is some infrastructure, but the development to get down there. So that's the most productive ounces you can possibly have. And of course, if we look across our operations, some of those pits that we've since shut were designed at like an $1,100 or $1,200 pit shell. So the question is, well, should we go back and use a higher gold price to design those pits and maybe do another cutback? That's tempting in the sense that you get more ounces, but you have to recognise it's going to increase your cost base as well, because the incremental ounce comes out at a higher cost. And so we as a company need to look at these sorts of things and say, what is important here to us? Is it ounces? Is it cost? Is it cash flow? And make determinations based on the facts as they present.
If I look across West Africa into Central Africa and across the continent, Burkina Faso, Mali, Sudan, Niger, there's been a lot of political events that haven't been necessarily for the positive of the country. How has your decade plus of experience in that part of the world shaped your thinking, and how do you view some of these specific jurisdictions going forward?
Oh, well, look, some of them are going through poor times now, but some are going well. I tell the story. The first time I went to Côte d'Ivoire was shortly after the end of the civil war in 2011. It was a fairly scary place. You go there today, it's a wonderful country and very prosperous and lots of activity going on. So countries ebb and flow, and this underpins the enormous importance of the portfolio approach that we've taken. Have multiple assets, multiple jurisdictions, work on the principle that at any given time one country may be struggling whereas another one's going well and another one's fairly ordinary or whatever. Just balance it out. Take the volatility out of your earnings, because if you think that every country is going to be fantastic all of the time, you're ignoring history. They have 5-year political cycles, countries come and go, governments come and go. So I think having a portfolio approach, balanced, is really, really important in taking this thing out of it. There are some countries that we wouldn't be going to today purely on a security basis. But, once again, it's very easy to make that judgment from afar. Quite often the reality on the ground is very different. And I'll give you a case in point of Sudan, where we do have a property. We're right up in the north of the country near the border with Egypt, and have seen no disturbance anywhere remotely close to our operation. Now you might say, well, if that's the case, why aren't you developing it? Well, there are some challenges in terms of getting through the ports and things like that, and being absolutely sure that you're going to have equipment when you need it, that make it challenging. But from a safety point of view, our people are on the site are safe. But, you don't want to push your luck, I guess, is what I would say under those circumstances.
you've done well, and Perseus in the history of the company has sort of surfed the waves of countries coming into a bit of a purple patch, and it's done quite well. And let's hope Tanzania stays the course and keeps going in the trajectory it's going. Sudan, like you mentioned, there was a bit of trouble over the past year or so. We'll see how that kind of eventuates. But is this a really deliberate part of the strategy to catch that kind of wave, or is it just where the opportunities have presented
No,
themselves?
it's deliberate, all right. I mean, we don't go to places unless we are convinced that there is a better future ahead. Now, you might say, well, gee, you got it wrong in Sudan, didn't you? And indeed we did. But it was on an upward trajectory. We did a lot of research into the situation, and we were all convinced that Sudan had turned the corner and was coming out. And it was until it wasn't. Now, what happens into the future remains to be seen. But, by and large, we do take a good look. We do our homework, we do our due diligence, and form a judgment. Now, we do take advice from a lot of people on some of these things, but you've got to have a good look.
In the case of Tanzania, there's still some final wrinkles to iron out in terms of a few clauses, the agreement with the government. How absolutely necessary is the long-term certainty of the dynamics with the government before FID?
Oh, look, we as a company, we say it's essential. We have to sort these things out. And the reason I say that is that, if you look at over time, the philosophy around investment has changed. So if you go back 25, 30 years, companies came into countries and, invested, took everything out basically and left little behind. That sentiment has completely changed now. And you can see in countries like Mali, for instance, where the government is sort of saying, well, hang on a minute, where's our share? Now, what the companies have done in the past was not bad or wrong, but it's got a different interpretation of the law today. So my view, and I had a meeting yesterday with the Deputy Minister for Mining here for Tanzania, and I said to him, look, we're going to be your partner for the next 20 years. And during that time, there's going to be periods where we have differences of opinion, but let's start off agreeing on what the rules are. Let's iron out the bugs now, and then we can go forward. And then we can deal with any differences that arise over time. And I think it's just prudent to do that, and it's in our shareholders' interests that we, eliminate as much risk as we can possibly do before we get going and starting to commit serious money to the country. But we're very optimistic about getting that underway, I might say. Everything's looking extremely good.
Just want to ask you about the actions of some of your peers. Specifically, Emerald comes to mind. They operate in Southeast Asia, and they've made a pretty deliberate choice to come back home, as it were, to where the headquarters is in Australia and buy an asset in WA, thinking about multiples that they trade on and trying to see a bit of an uplift. Mind you, they're trading quite competitively by all accounts anyway, but is that something that's sort of crossed the mind, or is Africa the
look,
edge
we have considered that from time to time. There are different views. I mean, either your African assets are going to be re-rated up, or your Australian assets are going to be de-rated down. Whichever. And I don't know how that works actually, but that is the possibility. But the reason why we're not rushing to come to Australia is that we believe that over the last 14, 15 years, we have developed a fairly large amount of intellectual capital on operating on the African continent. That gives us something of a competitive advantage over other folk. Now, if we were to come back to Australia, I'm an Australian for sure, but, having operated in the hurly-burly of WA is not something that I'm overly familiar with, and we would be starting at the bottom of the curve and have to build up that intellectual property again. So we think that by utilising, we've already invested a lot of money in learning the things we know, so we might as well leverage that knowledge and use it in a place where the projects themselves are fabulous, and by and large operating here is extremely good, as is evident by the results that we've produced over the last 8 years. It's pretty hard to argue with the scoreboard, and our scoreboard's looking pretty good.
You wouldn't have been able to build Perseus in WA either. It's like that the opportunities to develop assets were marginal relative to where you've got like low cost mines.
Yes.
Which I'd prefer a lower cost operation than one that has to turn off for half the cycle.
Well, it's an interesting thing, and this sounds like a cheap shot, and I don't mean it to be that. I just want to illustrate the point. But, we're all aware of our friends at Regis and the fact that their project got turned off after 10 years of working very hard at getting, McPhillamys licensed. Now, in that 10-year period, well, actually, truth be known, it's probably 12-year period, Perseus has licensed and built 3 mines in the same 10-year period that Regis was struggling to get one up and going. Now, that sort of says that, that people criticise Africa and say it's hard and all the rest of it, but you can get things done. If you go there with the right attitude, and the right attitude is extremely important, you go there with capital behind you and know-how, you can do extremely well. The right attitude is super important. You must, I believe, go there with the mindset of saying, look, we're going to generate significant benefits from this, which we are going to share with all stakeholders. So you have to recognise that the host government, the host community, your employees all have to get something out of their efforts. Because after all, we're bringing capital and intellectual property to the table, know-how, how to extract value from resources, but those resources belong to those countries and those people, and they do need to get rewarded for that.
Surely some Swick underground diamond drilling expertise might come in handy for Perseus.
I think you're onto something, Matty.
Correct, mate, with 17 million exploration drill metres underground, mate, and to go beyond the short holes, the Deep X division going down to 2,000 metres, and part of the Parenti group, mate, this is excellence unearthed. This is bloody unbelievable. And that excellence is being passed down every day.
Blue chip operators, Matty.
On to the next generation of Swick operators.
Yeah.
So, mate, might be a perfect fit over there.
I think you're onto something. Just on the theme of sort of cheap shops, maybe you can have another one here at another...
I said it wasn't a cheap shop.
At another competitor maybe, but you guys, to an extent, distinguish yourself by reporting an all-in site cost as opposed to an all-in sustaining cost. We've spoken in the past about corporate all-in costs and just the broader theme of how gold miners and miners talk about their costs. Tying in with that, some companies look at copper assets to pull down that all-in sustaining cost. Have you thought seriously about tweaks to the gold only focus, or has it always been gold only for Perseus?
Well, it's pretty much gold only, but I mean we have said that if we found a deposit that was polymetallic, for instance, had byproducts, then we wouldn't say no because it had byproducts. But we certainly wouldn't invest in a project to get credits. That's not quite what we do. So yes, if they came along, you'd always take them every day. But that's not our driver.
Portfolio rationalisation, Jeff. You've held on to your mines. Are you gonna sell the as mine life kind of gets more like lesser and lesser? Are you going to look to rationalise while there's still value on the table?
I think you've got to look at the portfolio and make sure that it's appropriate. I mean, we may or may not do that, but you certainly, there are times when an asset is more valuable to another party than to yourself, and if that situation was to arise and we could do that and earn some money and redeploy it more effectively, then you'd be crazy not to do that. But so we, as part of our strategic thinking, we think about those sorts of things, and there may be times in the future when we look at doing that exact thing. But I think before you do that, you need to have a line of sight to alternative production sources. So, like in our case, Nyanzaga would need to be, pretty well locked in, and possibly another asset as well before you started to look at reducing your production and cash profiles by divesting.
You've got roughly a quarter of your production over the next couple of years hedged out, and hedging is an interesting talking point at the moment in this rising gold price environment. Do you just look at that as security for the business, or will there come a time where you are hedgeless?
Hedgeless,
yeah, hedge-free, unhedged.
Maximally leveraged to the gold price.
Well, look, this is an interesting subject, and I can assure you, for the last 14 years or something that I've been with Perseus, it's been a hot debate with a lot of investors along the way. And my response has never changed. I say, look, I'm a professional manager. Price risk is arguably the biggest risk in the business. So, I really do need to do something to protect us against a bad situation. Now, I've, been in circumstance. Well, I've worked in the gold industry when the gold price was $200 an ounce, for instance, and even in Perseus's early years, in 2013, when the Hedging mine was not performing to standard, the thing that kept us afloat was we had, I think, 100,000 ounces of gold hedged at $1,800 an ounce, and the spot price went down to $1,000. So that kept us in business when, without that hedge, we arguably would have been struggling at that particular time. So I think there's a time and a place for hedging. I think you need to be, circumspect around it. We do about 24-25%. You've got to be very disciplined. For instance, what we do is whenever we sell gold, we always sell into the lowest priced hedges that we have in the book. And if the opportunity is there, we replace it with high price hedges, because what we don't want to do is create this massive contingent liability on the balance, or actually off the balance sheet, but there. And you've seen time and time again over the years.
Another cheap shot at a peer.
no cheap shots, but no. There are certain. You can point to examples where some large companies have gone, we've got to buy a hedge book back, and spend an awful lot of money doing it, only to see the gold price move in the opposite direction shortly thereafter. So I think, provided you have a logical, strategic rationale for what you're doing, provided you're disciplined about how you go about it, and you don't do crazy stuff. We don't do any fancy instruments that, are difficult. I take the view, if I can't explain this to what we're doing in words of one syllable to my board, we don't do it. It's as simple as that. So when, salesmen come in and want to describe the latest exotic product, we don't go down that path.
Keep it simple. I like it. How about just on the cost side? So you obviously the costs are in the control of the miner, not the sales price, and you have historically done quite well at seeing the margin improve and doing well. Do you look at hedging diesel and these sorts of things?
We have looked at it over the years, but in West Africa in particular, the diesel price, it's not a clean hedge with a correlation to the oil price. There are various subsidies and things like that come in. So it's not, you can do it in principle, but it's not a straight match. So you're taking some basis risk in any event. But we have looked at it from time to time.
Where are the best discoveries?
The best discoveries are in the ground, my friend. I've got no idea. I mean, honestly, actually, we really do like the Nubian Shield, in Sudan. We think that is, one of the most prolific, unexplored regions in the world. Now, it's unexplored for the reason that, it's been a tough jurisdiction or jurisdictions, I should say, for many years. But geologically speaking, it's wonderful. And I think that if people do get to explore up there's going to be some very, very major discoveries made in years to come. And I think, that fact has not been missed by several of the large majors who are up there sniffing around looking at those opportunities. So, areas like that haven't been worked over, I think have tremendous potential if you can actually operate on the ground.
Last one from me, Jeff. What was it that Johnny Mac understood about Perseus's business that others didn't?
Johnny Mac was a great analyst, I've got to say. He took the time to actually understand us. He visited our sites. He, got to talk to people, and he really, made a big effort to do that. One of the things I really liked that John used to report was, a chart that tracked all-in site costs against, or reported all-in site costs against costs as per movement on the balance sheet. The old lie detector, and I think West African resources and ourselves always appear at the bottom end of the curve, where what you see is what you get. And John was one of the first people, to come up with that
corporate all-in costs.
Yeah, that analysis, and I think that is a tremendous tool to be able to say, are these guys really generating cash or not? Because we have actually had situations in prospective M&A where you hear a person talk and they say, we're best in class on costs. and I look at the balance sheet and go, well, where the hell's the cash going? The fact is that they're not generating cash, and for us, that's what's really important.
We're big fans of that. I think that's a great note to leave it on. Thanks for making the time for us, Jeff.
Great. Thank you very much for having me.
Very, very good. I assume. Haven't listened to it yet. I'll listen to it once this is live.
Safe to assume that one, Matty. It was awesome. He's a real gentleman of the industry, and one that sometimes we don't speak enough about, given their African focus there. But they're a good operator that have just sort of built a pretty awesome track record over the past few years.
He could have done it easier for himself, couldn't he? Running an Australian mining company.
Wouldn't have been as fun, mate.
Nah, good on you, Jeff. Righto. Speaking of people that just do it easy, MMS. Geez, they move open pit dirt bloody easy. Ground it easy. Build a bloody camp piece of piss. Sandvik ground support. Do I need to say any more? CRE Insurance, an easy review of your insurance policies. K-Drill, easily the best exploration driller on the surface for RC and Diamond. Saltbush Contractor, I don't know who else hauls dirt on the surface. Nah, just Saltbush pretty much. Swick, 17 million drill meters.
17 million.
Oh, mate, Quartermaine Project Engineering. Mate, just easily the best bloke to ever deal with, Jeremy Palmer. And cross-boundary energy, Tim Taylor. That's all I have to say.
Leave it at that.
Hootaroo, Money Miners.
Have a good weekend.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.